If you're over 60 and you own gold, what I'm about to show you could be the difference between a comfortable retirement and a financial disaster. And I'm not being dramatic here. There's something happening right now in the gold market that most retirees have absolutely no idea about, and it's going to separate those who are properly positioned from those who are going to get absolutely crushed. Let me start with a question that should make you uncomfortable. When was the last time you actually verified your gold holdings? Not just looked at a statement, not just assumed everything was fine, but actually verified that the gold you think you own actually exists in the form you think it exists. Because here's what's happening right now, and this is where it gets really interesting. We're seeing the largest divergence in history between paper gold and physical gold. And if you don't understand what that means, you need to pay very close attention to the next 20 minutes, because this could determine whether your retirement savings survive what's coming. Let me paint you a picture of what's actually happening in the gold market right now. The COMEX, which is the major exchange where gold futures trade, currently has claims on every single ounce of physical gold in their vaults at a ratio of about 350 to 1. Think about that for a second. For every actual ounce of gold sitting in their vaults, there are 350 paper claims on that same ounce. It's like 350 people all holding deeds to the same house, and everyone thinks they're the sole owner. Now, this has been going on for years, but here's what's different now. The physical gold is starting to move. And when I say move, I mean it's leaving the vaults at a pace we haven't seen since the 1970s. In the last 6 months alone, COMEX registered gold inventories have dropped by 42%. That's not a typo. Nearly half the physical gold that was available for delivery 6 months ago is simply gone. Where did it go? Well, that's the fascinating part. It went east. China imported 1,250 metric tons of gold in the first 9 months of this year. India brought in another 850 tons. The Middle Eastern central banks, particularly Saudi Arabia and the UAE, have been buying at levels we've never seen before. They're not buying paper gold. They're not buying ETF shares. They're taking physical delivery of actual metal and moving it into their own vaults. And here's where this gets personal for you. If you own gold through an ETF, through a certificate, through allocated storage that you've never actually verified, you might be one of those 350 people holding a claim on the same ounce. And when the music stops, when people start demanding physical delivery, you're going to find out real quick whether you actually own gold or whether you own a promise of gold. Let me tell you a story that illustrates exactly what I'm talking about. In 2013, there was a German politician named Peter Gauweiler who started asking uncomfortable questions about Germany's gold reserves. Germany had 3,400 tons of gold stored in vaults in New York, London, and Paris. He wanted to know very simply, is our gold actually there? The Bundesbank, Germany's central bank, made a formal request to repatriate their gold. Not all of it, just 300 tons. The response they got was stunning. They were told it would take 7 years to return 300 tons of gold. 7 years. To return gold that was supposedly just sitting in a vault with Germany's name on it. Now, why would it take 7 years to return gold that's already yours? The only logical explanation is that the gold wasn't actually sitting there. It had been leased out, or hypothecated, or was being used as collateral for other transactions. When Germany finally did get their gold back, after years of delays, independent analysts who examined the bars noted something interesting. Many of the serial numbers didn't match the original inventory lists. The bars had been melted down and recast. Now, I'm telling you this story because if this can happen to the central bank of the fourth largest economy in the world, what do you think is happening with your gold holdings? If you own shares in GLD, the largest gold ETF, do you know that the prospectus explicitly states that you have no right to physical delivery? You own shares in a trust that owns gold, but you can never actually get that gold. You're 3 layers removed from the actual metal. And this matters right now more than ever because we're entering a phase where physical gold is going to trade at a significant premium to paper gold. We're already seeing it in certain markets. In China, physical gold is trading at a $50 to $80 premium per ounce over the London spot price. In India, the premium is even higher. This is unprecedented. This tells you that people who want actual metal are willing to pay substantially more than the paper price to get it. So here's what you need to do, and I mean this literally. You need to do this in the next 72 hours. You need to verify exactly what you own. If you own gold through an ETF, understand that you own paper. If you own gold through a certificate program, call them and ask about taking physical delivery. See what they say. See how long they tell you it will take. See what fees they charge. Their answers will tell you everything you need to know about whether you actually own gold or whether you own a promise. If you own physical gold in allocated storage, demand an audit. Demand to see your specific bars with your specific serial numbers. Don't accept a generic statement. Don't accept a photograph of a vault full of gold. You want to see your gold with your serial numbers, verified by an independent third party. Now, let me show you why this matters so much right now, beyond just the verification issue. We're entering a period where gold is going to do something it hasn't done since the 1970s. It's going to break free from the paper market manipulation and start trading based on actual physical supply and demand. And when that happens, the price is going to move in a way that's going to shock people. Look at what happened in 1980. Gold went from $35 an ounce in 1971 to $850 in January 1980. That's a 24 times increase in less than a decade. But here's what most people don't understand about that move. It wasn't a steady climb. Gold sat around $100 to $200 for most of the 1970s. Then, in the last 18 months, it went parabolic. From $200 in mid-1978 to $850 in January 1980. What caused that final surge? It was the moment when people realized that paper currency was losing value faster than anyone had anticipated. Inflation hit 13.5%. The dollar was collapsing. And suddenly, everyone wanted physical gold at the same time. The paper market couldn't handle the demand. Premiums exploded. Delivery times went from days to months. People were paying 20%, 30%, 40% premiums over spot price just to get actual metal. We're setting up for the exact same scenario right now, except the scale is going to be much larger. In 1980, it was primarily American investors driving the gold price. Today, we have central banks around the world buying at record levels. We have entire countries trying to de-dollarize their reserves. We have the BRICS nations creating alternative payment systems specifically designed to bypass the dollar. The demand for physical gold is coming from everywhere at once. And here's the kicker. There's less available gold now than there was in 1980. Global gold production peaked in 2018. We're mining less gold every year. The easy deposits have been found. The ore grades are declining. It now takes more energy, more capital, and more time to produce each ounce of gold. Meanwhile, demand is at all-time highs. The World Gold Council reported that central bank gold purchases in 2023 were the second highest on record, and 2024 is on track to exceed that. These aren't small purchases. Turkey bought 148 tons last year. China's official purchases were 225 tons, but independent analysts estimate their actual purchases were closer to 900 tons when you include purchases made through state-owned banks that don't show up in official reserves. Why are central banks buying so much gold? Because they see what's coming. They understand that the dollar's role as the global reserve currency is being challenged in a way it hasn't been since Bretton Woods. They're watching the U.S. national debt approach $36 trillion. They're watching the Federal Reserve's balance sheet, which has exploded from $800 billion in 2008 to over $7 trillion today. They're doing the math, and the math says that the dollar is going to lose significant purchasing power. And when that happens, when the dollar starts to decline in earnest, gold is going to be the only asset that maintains its value. Not stocks, because stocks are priced in dollars. Not bonds, because bonds are denominated in dollars. Not real estate, because real estate is leveraged with dollar-denominated debt. Gold is the only asset that has no counterparty risk, that can't be printed, that can't be devalued by government policy. But here's the critical point, and this is what most retirees are missing. Not all gold is created equal in this environment. Paper gold, ETF shares, certificates, allocated storage with banks, all of that is going to underperform physical gold that you actually possess. Because when the crisis hits, when people start demanding delivery, the paper gold market is going to freeze up. Premiums are going to explode. And if you don't have physical metal in your possession, you're going to be stuck. Let me give you a more recent example of exactly what I'm talking about. In March 2020, when COVID hit and markets were panicking, something very strange happened in the gold market. The paper price of gold, the futures price on COMEX, actually dropped. It went from $1,700 to $1,450 in a matter of days. But physical gold? Physical gold coins and bars were selling at massive premiums. American Eagles were going for $200 to $300 over spot. You couldn't find physical gold anywhere. Dealers were sold out. Mints stopped producing. Delivery times went from days to months. So you had this bizarre situation where paper gold was saying the price was $1,450. But if you actually wanted to buy physical gold, you were paying $1,700 or more. The paper market and the physical market completely disconnected. And if you owned paper gold during that time, you couldn't convert it to physical. You were stuck watching the paper price while the physical metal you actually wanted was trading at a huge premium. That was a preview. That was a 2-week disruption in a relatively stable market. Imagine what happens when we have a real currency crisis. Imagine what happens when the dollar loses 20%, 30%, 40% of its value over a period of months. The premium on physical gold is going to be enormous, and if you don't have physical metal before that happens, you're not going to be able to get it at any reasonable price. Now, I want to address something that a lot of retirees are dealing with right now. You might have significant retirement savings in IRAs or 401ks, and you're thinking, well, I can't just go buy physical gold with that money without taking a massive tax hit. And you're right. If you liquidate a traditional IRA to buy gold, you're going to pay ordinary income tax on that distribution, plus potentially a 10% penalty if you're under 59 and a half. But here's what a lot of people don't know. You can hold physical gold inside a retirement account. It's called a gold IRA, and it allows you to take your existing retirement funds and convert them into physical precious metals without any tax consequences. The gold is held by a qualified custodian, but it's allocated to you specifically. It's your gold, with your serial numbers, segregated from everyone else's holdings. I put together a detailed guide on exactly how this works, how to set it up, what the costs are, what to watch out for. It's completely free, and you can find it in the description below. If you've got $100,000 or more in retirement accounts and you're concerned about what we've been discussing, it's worth taking a look at. It covers the whole process, the tax implications, how to choose a custodian, everything you need to know. All right, back to what's happening in the gold market right now, because there's another layer to this that's absolutely critical. We're not just seeing a divergence between paper and physical gold. We're seeing a complete restructuring of the global gold market. For the last 50 years, London and New York have been the centers of the gold market. The London Bullion Market Association and the COMEX in New York have set the global gold price. But that's changing. China launched the Shanghai Gold Exchange in 2002, and it's now the largest physical gold exchange in the world by volume. More physical gold trades in Shanghai every day than in London and New York combined, and the Shanghai price is increasingly diverging from the London price. Chinese buyers are paying more for physical gold than the paper price in London, and they're doing it consistently day after day. What does this tell us? It tells us that the center of gravity in the gold market is shifting east. It tells us that physical gold is becoming more valuable than paper gold, and it tells us that the price discovery mechanism is breaking down. For decades, the price of gold has been set by paper trading in London and New York. But increasingly, the real price of gold is being set by physical demand in Asia. This has enormous implications. Because if the paper market in the West loses its ability to set the gold price, if physical demand in the East starts driving the price instead, we're going to see gold move in ways that the traditional models don't predict. The technical analysis that works in a paper-dominated market doesn't work when physical demand is driving the price. And we're already seeing signs of this. Gold has been making new all-time highs in 2024, but the traditional gold investors in the West aren't buying. ETF holdings are actually down. Western investment demand is weak. So who's driving the price higher? Central banks and Asian buyers. They're buying physical metal, and they're willing to pay higher prices to get it. This is a completely different dynamic than we've seen in previous gold bull markets. In the 1970s, it was Western investors driving the price. In the 2000s, it was a mix of Western investors and central banks. But now, it's almost entirely central banks and Eastern buyers. Western investors are sitting on the sidelines, watching gold make new highs, and they're not participating. What happens when Western investors finally wake up? What happens when American and European investors realize that gold is breaking out to new highs and they need to own some? They're going to try to buy, and they're going to find that physical gold is very hard to get. The mints are already running at capacity. Dealers are already seeing longer delivery times, and we're not even in a crisis yet. When the crisis hits, when the dollar starts to decline in earnest, when inflation starts to accelerate again, the demand for physical gold is going to overwhelm the available supply. And if you're trying to buy gold at that point, you're going to pay enormous premiums if you can get it at all. This is why I'm saying you need to check your gold holdings now. Not next month. Not when you see gold hit $3,000 or $4,000 an ounce. Now. Because the window to convert paper gold to physical gold at reasonable prices is closing. The window to verify that your allocated storage is actually allocated is closing. The window to get physical metal delivered in a reasonable time frame is closing. Let me give you some specific numbers that illustrate just how tight the physical market is getting. The U.S. Mint sold 1.2 million ounces of gold eagles in 2023. That's the highest level since 1999. But here's the thing. The Mint has had to ration sales to dealers multiple times this year because they can't produce enough coins to meet demand. They're running their presses 24/7, and they still can't keep up. The Royal Canadian Mint is in the same situation. The Perth Mint in Australia is in the same situation. Every major mint in the world is struggling to meet demand for physical gold coins and bars. And again, this is before we have a real crisis. This is just baseline demand from investors who are starting to get nervous about the financial system. Now think about what happens when that baseline demand doubles or triples. Think about what happens when people who have never owned gold before decide they need to own some. Think about what happens when retirees who have their entire net worth in stocks and bonds decide they need to diversify into gold. The mints won't be able to produce enough. Dealers won't be able to source enough. Premiums will explode. And if you own paper gold at that point, you're going to be in a very difficult position because the paper gold market is going to freeze up. We saw it in March 2020. We saw it in 2008. We saw it in 1980. When everyone tries to convert paper to physical at the same time, the system breaks down. Delivery times go from days to months. Premiums go from 2% to 20% or more. And in some cases, delivery just stops altogether. This is not theoretical. This is not fear-mongering. This is what happens in every gold market crisis. The paper market and the physical market disconnect. And the people who own paper gold find out that they don't actually own gold. They own a claim on gold that they can't enforce. So what do? First, you verify what you own. If you own gold through an ETF, understand that you own paper, and consider whether that's appropriate for your situation. If you own gold in allocated storage, verify that it's actually allocated. Call the storage facility. Ask to see your specific bars. Ask about their audit procedures. Ask about their insurance. Ask about their delivery process. If you own gold coins or bars at home, make sure they're properly secured. Make sure you have adequate insurance. Make sure your family knows where they are and what they're worth. Physical gold doesn't do you any good if it gets stolen or if your heirs don't know it exists. Second, consider increasing your allocation to physical gold. I'm not saying you should put your entire net worth into gold, but if you're a retiree, if you're living on a fixed income, if you're worried about inflation and currency devaluation, having 10% to 20% of your assets in physical gold is not unreasonable. It's insurance. It's protection against the kind of monetary chaos that we're increasingly likely to see. Third, think about the form of gold you own. Coins are more liquid than bars. Smaller denominations are easier to sell than larger ones. Government-minted coins like American Eagles or Canadian Maple Leafs are more widely recognized than private mint bars. These details matter when you need to sell or when you need to use your gold as currency. And fourth, think about where your gold is stored. If it's in a bank safe deposit box, understand that banks can restrict access to safe deposit boxes during a crisis. It's happened before. If it's at home, make sure it's properly secured. If it's in a private vault, make sure the vault is reputable and properly insured. The bottom line is this. We're entering a period where the difference between owning paper gold and owning physical gold is going to matter enormously. The paper gold market is over-leveraged, it's fragile, and it's going to break down when stress hits the system. Physical gold is going to trade at significant premiums to paper gold, and if you don't have physical metal before that happens, you're going to find it very difficult and very expensive to get it. This is not about timing the market. This is not about trying to buy gold at the absolute bottom and sell at the absolute top. This is about making sure that the gold you think you own is actually gold that you own. It's about making sure that your retirement savings are protected in a form that can't be devalued, that can't be frozen, that can't be confiscated. The retirees who are going to come through the next decade in good shape are the ones who understand this. They're the ones who have verified their holdings. They're the ones who have converted paper to physical. They're the ones who have taken possession of actual metal. The retirees who are going to struggle are the ones who assumed everything was fine, who trusted that their ETF shares or their allocated storage or their certificates would be there when they needed them. Don't be in that second group. Check your gold holdings. Verify what you own. Make sure you have physical metal that you can actually touch. Because when this paper gold market finally breaks down, and it will break down, the difference between paper and physical is going to be the difference between financial security and financial disaster. And by then, it will be too late to do anything about it.